We're a little on the accommodative side.
I think we're shifting to a place where it would be most appropriate for them to start raising rates.
The market has this angst around the reaction function, around Fed credibility.
You actually have to take action. Words are cheap.
If you look at the inflation picture in aggregate, it feels like it is sort of a call to action.
This is Bloomberg Surveillance live from Jackson Hole with Tom Keene and Lisa Abramowitz.
From Jackson Hole for our audience worldwide, this is Bloomberg Surveillance on television and radio. We're sitting in front of the Grand Tetons, as we typically do in late August for the Fed's annual gathering. But this year, the view is cloudy for both the rocky peaks and a new era of monetary policy. Kevin Warsh making his debut as Fed chairman at a time when everyone is asking, who is Fed Chairman Warsh? And just how different will his tenure be? Good morning, I'm Lisa Abramowitz alongside Tom Keene at Jackson Hole. It feels very different this year at a time where Kevin Warsh is marking almost 100 days as the Fed chairman.
Well, he's been here since 1951. I was here a little bit after that. There have been other times of tension, like in 2007 after the markets blew up. But this time is uniquely different. Total focus on this speech we'll hear.
How much is the long-term yield very much in focus, given how much it has risen since March
Really
22nd?
important question. The answer is less than 10 days ago. That's the good news. But you got little tea leaves out there, idiosyncratic Philippine peso like a record weakness this morning, and you see it in the tension of the foreign exchange market with DXY elevated here. You can see it in foreign exchange on the Bloomberg, Lisa. Everyone's tuned into this.
Let's take a look at what is going on in markets right now. It is pretty quiescent as everyone awaits with bated breath Fed Chairman Kevin Warsh as he steps to the podium in just about an hour time. Right now, little change on S&P futures, up just about 0.1%. Euro-dollar going nowhere after the dollar has lost significant ground since May 22nd when Fed Chairman was sworn in. 10-year yields elevated at 4.68%. Brent lower just a touch, $89.06. Coming up this hour, we've got Cleveland Fed President Beth Hammack, former Kansas City Fed President Esther George, Bank of England Monetary Policy Committee member Catherine Mann, Cornell University Professor Eswar Prasad, and in the next hour, former Fed Vice Chair Rich Clarida, as well as Citi Wealth CIO Kate Moore. We have alongside us someone who has been here not since 1951, but who has been coming to quite a few of this. Michael McKee, of course, our chief economic correspondent. How does this time feel different?
It feels a little different in that Kevin Warsh is making his debut here as the Fed chair, and that's always interesting to see how they handle themselves in front of an audience that is their peers, basically. Warsh has been here before as a Fed governor, but he wasn't the person people looked to at the time. Now he is the man who is supposed to give direction to the central bank, which then feeds into direction for the markets. And he's sort of refused to do that so far. So there's a lot of focus on what he's going to say and whether he's going to stick to his guns about not giving guidance at all, let alone forward guidance.
I think it's appropriate that it's kind of raining and cloudy right now. It kind of gives the scene center. It gives a sense of just the mood on the ground.
Yesterday, the hills were alive with the sound of music, and the somberness today really nails it.
Yeah, as clouds rolled in late last night, Fed officials were gathering in the main hall. And joining us now is one of those Fed officials, Cleveland Fed President Beth Hammack. It is so good to have you, President Hammack, on set with us this morning. You have been very vocal about your desire to raise rates, that you think that the inflation has been too hot for too long. Have you heard anything at this meeting that changes your mind?
Well, the meeting starts in earnest this morning with the chairman's speech, and that'll be the kickoff. The data that I've seen since our last meeting has been, to me, very much in line with the picture that I was seeing before. And of course, I'm setting my policy views based on the forecast of where I think policy is where I think the economy is headed, rather than where we were over the past several years. But we've been missing on our inflation target for more than 5 years. My forecast is that we're going to continue to end this year around 3% inflation, and by the end of 27, we'll hopefully get down to mid 2.5s, mid 2%. But that's not meeting our 2% objective. So to me, there's no tension in our mandate. We've got an employment picture that's right around my estimate of maximum employment. It's been stable and in balance for the past 12 months, and we've been missing on the inflation side. I don't see restrictiveness in the markets. When I talk to people in the capital markets, what I'm hearing is that capital is free flowing. Investors are looking to put more capital to work. Businesses are looking to make bigger investments. And so I think we need to put some restriction into policy And so I believe it's time to act for us to do that. The longer that we wait to get inflation under control, the more pain is felt by everyday Americans, and the more difficult it may be for us to ultimately get back down.
We were talking last night about the meanings of the word the reaction function, and some of our colleagues were saying, "Wow, that's kind of a fancy name,
Super technical,
super technical name."
mathematical formula.
What is it that Kevin Warsh is not doing? I mean, how do you define what Wall Street is looking for, and how do you put your own views into that?
Well, I can't tell you anymore what Wall Street's looking for because now I'm on the policymaker side. I'm no longer on the market participant side. But I can tell you I view communicating about my viewpoints as a critical part of the job. I think talking to the public, listening to the public, hearing what they're experiencing, hearing how they're seeing the economy unfold is a critical part of what I do every day. And I need to help put my views out there so that businesses and households can make better informed decisions. I like to tell people when new data comes in, how is that going to change my perspective? How might that change the decisions that I and maybe my colleagues are going to make? Because I feel like that will help them to manage their businesses and their household finances.
Well, when you look at what the chair might have to say today, kind of the bottom line question for other members of the Open Market Committee is, how do you feel about the idea of not giving forward guidance, and particularly given your background, having the bond market tell the Fed what it thinks is happening in the economy?
Well, the markets are definitely one component that I look at. Financial conditions and FCI indices are something that I spend time looking at to get a sense of how monetary policy is transmitting into the real economy. But having spent 30 years in markets, I can tell you that market participants tend to be focused on making money for themselves and their clients. And they do that by betting on what the Fed will do, not what the Fed should do. And so I think markets are an important complement, but not a substitute for the Fed.
You're underselling yourself. 30 years, you were sterling in the repo market at Goldman Sachs. There's no one in the history of the Fed that understands short-term paper like you do. You got it done. But it's true. You undersell yourself.
I think we have a lot of experts. The staff is incredible at the Fed. That has been one of the.
I agree with that. Plus, you're out of Cleveland Fed, where you invented in 1983 how we look at inflation with the Cleveland series. Do you still see trust in the market before and after this speech? And the litmus paper, the narrowness of the repo market, do we still see trust in what we're doing?
I think our credibility comes from our ability to deliver on our commitment to the dual mandate. And we are committed to delivering on bringing inflation back down to target.
So this is critical. Edgar Danny published, I was literally, you had Wall Street, sorry. I was coming out United slow motion. And Edgar Danny published that, look, where nominal GDP is, we have plenty of room. Let's not fear. That says raise interest rates. Let's raise them because we're nowhere near nominal GDP. Discuss that dynamic.
I think what I'm seeing is that there's not a lot of restriction in the economy. You see in businesses going out and raising lots of capital, trying to make new investments. That is good for growth. That can be helpful. But as Ed Giordani points out, we've been seeing GDP growth coming in above what I think of as kind of long-term averages. Mm-hmm. When you have that kind of growth, that can put pressure on inflation. That can put pressure on people.
Hello, my name is DrPaulCottrell. We are live streaming on Rumble, YouTube, and my website, the-studio-reykjavik.com. Make sure you subscribe to all the channels. I have YouTube, Brighteon, Bitchute, Rumble, X, GETTR, Substack. So there's many ways to watch all these free videos. Share the links and ask your social media to follow me. What we're going to do is go over the markets today. Today is a big day for the financial markets because of the symposium that's taking place at Jackson Hole, Wyoming. The Fed chair is going to speak, and hopefully we get a better idea of what's going on with the yield curve. And that's going to be related to bonds. That's going to be related to interest rates, inflation. A lot is going to happen today. So we need to kind of pay attention to what's going on. Now, right now, the futures market is slightly up by about 8.5 points for the S&P 500. And that future price is 7,750. I have a year-end target of 7,800. It might hit 8,000, but I've been telling everybody at about this range, around 7,800, from where we're at right now to about 8,000, you want to have about anywhere from 5 to 10% in cash. And so you're going to be 95 or 90% invested in the broad equity market, either S&P 500 or Russell, but something broad. That way, when the downturn does happen, you can deploy that 5 or 10% in cash back into the market and get a better entry point. So you just wait it out, all right? But you still want to be heavily invested. So this is just a little bit of a way to hedge it. There's other strategies where you can buy a put or sell a call and create these complex strategies. But for the average person, just take 5 or 10% of your portfolio, put it in cash, and just wait it out. And once you start hearing that there's a big sell-off, then you want to deploy the cash. I cover the markets every day. Most days I'm live streaming, and so I'll be telling you when to do it. So just pay attention, and you'll make money. So please go to my website and help support the work that I do. I have products that will help to improve your health, and if you pay attention to me, you'll make money in the market. All right? So some of the products that I have that will help to improve your health that I take on a regular basis is magnesium and zinc. Magnesium and zinc is going to help to boost up your immune system and help with brain function. There's not enough people in the United States that's taking magnesium to help to improve that brain function and slow down the aging process of the brain. So it's really important to take this magnesium and zinc, help with brain function, help with your immune system, and by taking this regularly, you're actually slowing down the aging process, especially for the brain. And Good Night Formula. Good Night Formula will help to get you into 3 to 5 cycles of REM sleep and deep sleep. So you're detoxifying your central nervous system, you're consolidating memory, and you're going to be well rested. And when you do this regularly, you're actually slowing down the aging process and improving brain function. Take it at night. It has tryptophan, melatonin, GABA, and passion flower. So please go to my store, get the Good Night Formula, and get the magnesium and zinc. And magnesium also helps with the efficacy of vitamin D3. It'll help to improve the effects of vitamin D3. And if you take magnesium at night, you actually have better sleep patterns. So you get a lot of benefits if you just listen to me. So please go to my store, use discount 5, all caps, discount 5, so you save some money. You get $5 off. You can use that discount as many orders as you want. But get the supplements and get healthy. And that's how you're going to reduce your healthcare costs. The government isn't going to do it for you. You're going to have to look in the mirror and say that you're taking charge of your own life, just like you have to take charge of your own finances. Your work isn't going to care about you, especially when they start laying people off because of AI. You need to look in the mirror and say, the government's not going to take care of you. Your company's not going to take care of you. You are going to have to take care of yourself and your family. And the only way to do that is to make sure that you're proactive in your health and proactive in your finances. And that's why I do this show. So please go to my store, the-studio-reykjavik.com. All right, we're going to continue on with the coverage from Bloomberg at Jackson Hole.
Not many people have that kind of conviction at this point, but she, with her long experience in the markets, she's got some pretty good insight. We're back with inflation to where we were when the war started, and that wasn't good enough for Beth Hammock and the others then, so we would expect it not to be good enough now.
Well, about 45 minutes until we hear from the big man himself. Coming up next, former Kansas City Fed President Esther George on a special edition of Bloomberg Surveillance on television and radio.
All right, so what I want to do is we'll hit some other topics. This is a clip from Fox Business about Mamdani and the housing policy.
Why are you still using bots for your meetings? How else am I going to remember what happened? Just use granola. Okay, what's granola? With granola, you get all the boards. Again.
Mayor Zoran Mamdani rolling out a new fast-track court system for what the city calls critical cases, putting more pressure on landlords to make repairs.
Oh, but here's the kicker. How are landlords supposed to pay for those expensive fixes when this very same mayor just ran through a citywide rent freeze?
Our next guest made this helpful video so Zozo can understand the issue and the real fix.
Almost half of the rental apartments in New York are rent regulated. About 50,000 of them stand empty, many of them because their landlords can't charge enough to make up for the cost of necessary repairs. So how do you lower rents? Build more housing.
That's Wall Street Journal Free Expression's senior newsletter editor, Emma Camp, and she joins us now. Emma, it's great to have you on the show. Congrats on that video. It's a fantastic piece of work. We hope you do more of it. You were talking there about you can't really lower rents if you're doing the rent freezes, right? All this, but it also gets to the issue you can't maintain an apartment building if you're squeezing landlords. They don't have money to fix these apartment buildings, and now the mayor wants to take them to this new court and kind of nail them once again.
Yeah, absolutely. That's one of the problems with the housing supply in New York is something like 50,000 apartments stand empty because they are rent regulated or rent controlled, but landlords are legally prohibited from charging enough to earn back the cost of necessary repairs to make those apartments habitable. And I kind of have mixed feelings about this proposal from Mamdani, because obviously a lease is a contract, and if your landlord isn't upholding their end of the contract, they should be held to account. You know, we all have had experiences with bad landlords, but I also think it's important to give context here, which is that a lot of the time, if you're tied up with tenants who aren't paying and you have to spend years and years and so many legal fees to evict them, you can end up in a situation where you literally do not have the money in the bank to make repairs that are necessary to keep, paying tenants in a good situation.
It seems like this court, though, is pro-tenant, anti-landlord, the way it's certainly being described, and to fast-track for critical housing cases. But I thought about it. The tenants who are, say, socialist pro-Mamdani, I'm thinking of that Nepo baby record producer, Mamdani, Friendo, who she moved into this apartment out in Brooklyn and immediately stopped paying her rent because she saw cockroaches, and she rallied all of the tenants. And then the owner, a Nigerian immigrant owner of the building, went into foreclosure and lost the building. So I think about those tenants, they don't actually want to go to court. They don't want to be forced to pay the rent. So I wonder how much this court's actually going to get used. If it's, if they'll go and say, hey, I really want my landlord to get rid of the roaches. If it means paying their rent, they're not going to go.
Yeah, I think that's a pretty reasonable concern. I think that, everybody needs to be sane when it comes to this housing issue. The problem is that a lot of people are not sane. And I think if we had a world in which both landlords and tenants were expected to hold up their ends of the bargain, we would be in a lot better situation.
Can I put my cynicism hat on for a second? I think these courts are designed to get tenants in there, put landlords on the spot, tell them they're not doing a good job, rack up so many violations that the city says, you know what, you can't keep your building anymore. We're not going to let you do that. We're going to try to seize this building. I'm kind of a believer in the city wanting to take these buildings over. Am I being too pessimistic here, Emma?
I don't think you're being too pessimistic at all. This is a very real concern of mine. I think a lot of these socialists want more government-owned housing. In their ideal world, there are no landlords, because if you live in a house, it's because the government owns it. And this is 100%, I think, partially a scheme to enable the city to take over more private buildings.
Explain to me how people voted for Mamdani thinking that more New York City run public housing is the answer, when our public housing here has had violation after violation. There have been charges by the Department of Justice, there have been bribery scandals, lead poisoning and the like, but somehow they think, again, it's like he's going to make a success out of something that's been an abject failure for decades.
Yeah, I think a lot of the problem here is that people are very naive. You were 100% correct to point out that public housing in New York is often not a nice place to live. They're really not very good apartments. And the difference is that when your landlord doesn't uphold their end of the bargain, you can at least sue them. When the government doesn't uphold their end of the bargain, it's a lot harder to get justice. And so I think what we really need to be doing here is focusing less on these sort of socialist proposals, because I think a lot of times people are in favor of these proposals against all evidence, right? You can point out to them, rent control doesn't work, government-owned housing isn't a very nice place to live, and they will ignore you. And so I think it's better to sort of pivot to like, okay, how can we actually meaningfully increase the housing supply and make...
All right, let's go over some of the markets right now. The markets are going to open up. The cash trade is going to open up in 10 minutes. I did a decent profit in the pre-market session in natural gas. Now, natural gas is trading at 2.895. We're now going into, we're going through contract switching for the futures market. So now we're moving into the October futures and moving into the fall. Typically, natural gas starts to tick up. And if you've been paying attention to the show, I've been shorting with a little bit of hedging natural gas. Made a ton of money. If you just followed what I did, you would have done so too. All right, so now we're moving into contracts for the fall, and natural gas should tick up. Now, the headwind for that is the fall and winter may be actually warmer this year compared to previous years because of El Nino. Now, another aspect to that is a tailwind, data centers, the use of natural gas. And it seems as though the stockpiles, underground storage for natural gas, for the reports that have been coming out, there was one report that came out last week and the one that came out the week before, it's been ticking up slightly, but less than the average. So the replenishment rate on average is a little lower, but it is up higher than the usage. So there's a little bit of an increase. So that possibly could be a headwind. But typically, natural gas starts to tick up. So what does this mean? It means that instead of a 2.6 to about a 2.8 range for natural gas, now we're going to start shifting the range. The range now is going to be around, I suspect, around 2.8 to around 3, maybe 3.1. But it's heavily predicated on what happens in the Middle East and what's happening with the weather and how much storage, underground storage, is increasing or decreasing. If it decreases, bam, it'll pop up. If it increases, then there's going to be some volatility to that. This is the reason why you do a slight hedge. So you go more on the long and a little bit short, a little bit less on the short of natural gas. And the way to play it is boil and cold. Cold is to short natural gas. Boil is to long natural gas. And cold is spelled with a K, all right, for the ETFs. So this is, and you just dynamically hedge this. So that's what I've been doing. And all right, so right now it is up, it's at 2.9. I do have a short in natural gas, a small one, and I probably will put a larger long position in on Monday. Now, in terms of oil is trading at 82.47. I put a long position in today, and I had a short position. I closed the short position because throughout the pre-session, oil has been trading down. So I probably will put in another short position as a hedge to my long position. For the S&P 500, it's at 7,750-ish. 7,747 for the futures market. There's going to be a resistance level at 7,800, and there's going to be another resistance level at 8,000. And again, if you haven't already, you might want to put 5 to 10% in cash and hold it there, or cash equivalents, and just wait it out and just ride it. Now, I have not put any additional positions in the S&P 500 or in the Russell 1000. Now, what I'm looking at today is Gush and DRIP. Gush is trading right now, pre-session at about 43.24. It heavily tracks XOM, ExxonMobil. So I'm going to wait until the market opens, take a look at XOM, and either long or short. And Gush is longing the energy companies, and DRIP shorts the energy companies. DRIP is trading at 36. I don't think I'll do a hedge on either Gush or DRIP, but something might happen during the session, and I'm not sure. Now, the news with Jackson Hole, it's all going to be about bonds. When Warsh talks, the question is he going to raise rates or lower rates? Is he going to? And if he's going to raise rates, then the front of the curve is going to go up, but the back of the curve may go up and then go back down because the Fed is worried about inflation. If they stay at the same level, I don't think they're going to cut rates, but if they stay at the same level, do nothing, then I think the yield curve is going to shift upward, and the whole yield complexion is going to move up. Now, for the 10-year, the 10-year right now is 4.68, and the 30-year is at 5.2. So if we don't control this inflation and the Fed doesn't give confidence to the bond market, we're probably going to be seeing a 5-ish for the 10, and we're probably going to see a 5.75, 5.5 for the 30. So this is the reason why today is such a big day. It's all about bonds, interest rates, what the Fed is thinking about, and if there's a little bit of a concern that the rates are going to go up, then I would suspect the stock market will sell off today. But we'll see. We'll see what happens. Please go to my store, the-studio-reykjavik.com, and get the Max 35. Max 35 will help boost up that immune system. You take a teaspoon a day, swish it in your mouth, gargle about 20 seconds and swallow. It neutralizes, it improves your oral cavity, your oral pharynx, helps to maintain a mucosal barrier, and helps the health of your epithelial cells. By doing that, you're boosting up your innate immune system. This is perfect to take year-round. Take a teaspoon a day. I take a teaspoon a day every day. I've been doing this for over 6 years. And during the cold season, it helps to neutralize, and that's really important. So please go to my store and get the Max 35 or the Cleanse. They're at different parts per million. Max 35 is 35 parts per million. Cleanse is 30 parts per million. All right, with that, let's go back to Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next?
On this episode, we are diversifying. You can see from toast and sugar, salt, soybean, refined products, fertilizer. If you look at it, we want to export value.
Premieres August 28th, only on Bloomberg.
There is a cloud hanging over Jackson Hole this morning, both literally and figuratively. Good morning from Jackson Hole. This is Bloomberg Surveillance. Take a look at that. It really is just nestled into the peaks of the Grand Tetons to give us a sense of the mood as we await Fed Chair.
It's really fascinating. Last night, for the first time in 18 years, I actually saw lightning. I think it was after the third day.
Yeah.
So maybe I just saw it, but the lightning and the thunder last night was just stunning.
Yeah, stunning and potentially momentous heading into this speech. Right now, as the market opens, we do see everything pretty much flies at the NASDAQ down about 0.2%. When you take a look at 2s, 10s, and 30s, yields higher across the board, but not really doing much. Really, the fireworks will come in about a half an hour time. Watch the 30-year yield, 5.1962%. I did that just for you, Tom, because I know that you look out to for that.
It's surveillance.
It's important, and right now we're seeing it just in front a little higher, but really so much higher than it has been.
Let me frame that out. I think, you're going to keep going here. Great. Eurodollar.
Eurodollar. Well, look, I know you think it's too much, but the Eurodollar is the other key indicator after the Fed Chair in March. How much credence do people have that this Fed, that this FOMC is committed to bringing down
inflation? And then Global Wall Street, we thank you worldwide on television and radio for tuning in. For Global Wall Street, they're going to go over to Euro Yen, take the dollar out, and just today there's a little bit of this. All the foreign exchange systems. I mean, Philippine peso is idiosyncratic to a record low. But here, there's
the technical for this.
This is the technical for this. It's febrile. Is that pronounced it right?
Yes.
I nailed it. Okay. But the answer is 30 minutes into this speech, there's a tension within the markets, as you correctly show in Eurodollar.
The anxiety, the angst, the questions. Who is Fed Chair Kevin Warsh?
Well, that's the point. There's no questions. I mean, there's not going to be questions in his speech.
Right.
That would be different.
It would be different, although it's unclear whether he would answer any of them. Who will answer our questions is New Edge Wealth CIO Cameron Dawson, who does join us now. Cameron, great to see you. And thank you for zooming in to join us here in Jackson Hole. How important is this speech? Do you think it actually could make the difference for traders who have been a bit nervous, jumpy around the FOMC's reaction function?
Well, to Tom's point, there's no question. So if Warsh wasn't willing to answer Mike McCree's question from the last press conference about what are you waiting for when it comes to rate hikes, we're not really certain that he's going to give guidance today. And I think the important thing to ask is whether or not there's been enough movement within markets to suggest that he needs to change his communication strategy. He has been very taciturn, but we have seen some movement in markets, but we don't really think it's enough. You effectively see the 30-year Treasury yield up a whopping 6 basis points since the July press conference. And if you look at things like inflation break-evens, they're still very much contained. So yes, there has been movement higher in bond markets, but this is not a bond market that is screaming for Fed Chair Warsh to temper inflation expectations because they're still sitting at 2.4%, meaning they still have faith, alarmingly, faith that the Fed will get back to its 2% target.
Kim Dawson, you start every morning looking at the BTMM screen on a Bloomberg, and you're looking at money market rates and that. If we see the 2-year come up, if we see money market rates come up, does that mean less cash will migrate to equities?
Not necessarily. We've never really considered this fungibility of money market rates needing to be the thing that drives equity higher. At the end of the day, you've continued to see money market balances climb to new trillions of dollars, and you've seen equity rallies. I think the bigger question for us is what happens to financial conditions as we move into a potentially new policy regime. Just 2 weeks ago, we hit an all-time, at least for this cycle, easiness in financial conditions. Look at the Bloomberg Financial Conditions Index. It was above where it was in 2021.
Yes.
This is reflective of very capital markets, and just suggests that there is no evidence based on looking at markets that the Fed is even mildly restrictive and potentially very far from restrictive.
Cameron Dawson of New Edge Wealth, thank you so much for being with us. As the rain starts to drizzle down, there's a
like it's in Mary Poppins.
I think we're just taking to London. It's funny, we just dropped it by. Yeah, well, it feels like it. But Bank of England Monetary Policy Committee member Catherine Mann dropped by because the weather is just so familiar.
Well, actually, this year, of course, it's been a drought in London, but I'm trying to kind of bring it back.
Yeah, so maybe we can enforce some of this. Catherine, thank you so much for being with us this morning. morning, I am wondering how much you have other people on your side when it comes to being hawkish right now. Because I know you've been a very vocal hawk. You tend to be really hawky and been very vocal about it. Is this something where you're finding a lot of compatriots here?
Well, there are three of us, I suppose.
What I just did was I put a position in DRIP and trying to wait it out. When the market opened, ExxonMobil was down and most of the major energy companies were down. So I'm playing that open downturn for the energy companies by trading DRIP.
Of the Bank of England. Okay, great. When I look at this, I'm looking at a restrictive set of events. What will happen if we raise interest rates in America?
Well, it's been very important, the spillovers from the policy in the United States as well as the macroeconomic conditions. These are very important ingredients to my financial conditions and also to the state of the UK economy. So there's a lot of crossover, there's a lot of spillover, but I would have to see what the implications are for the financial conditions and whether or not those spillovers are appropriate for the economic conditions in the UK.
And the bill of this, folks, is serious. We're talking here with a public official of the Bank of England, so she's going to give me a non-answer. So I have to rephrase the question to try to crowbar it out of Professor Mann. Codependency, China, U.S., codependency, the Chancellor of the Exchequer and the Bank of England or Treasury and the Fed. How in your study does the codependency work between fiscal authorities and monetary authorities?
Well, of course, what fiscal authorities choose to do or the certainty about what they might be doing has an implication for the business conditions, for the level of economic uncertainty, and that, of course, has implications for economic activity. It also matters for the financial conditions. The financial markets are going to be reflective of the prospects for fiscal conditions, as well as the uncertainty about what those fiscal conditions might be.
Right now, do you feel like central bankers have kind of had a changed vision? And I'm asking this in the respect that we're talking about interest rates, to combat inflation that's being created by things that are far outside growth, that are far outside some sort of acceleration in economic dynamism. This is about oil supply shocks. Right. This is about tariffs. This is about AI build out. Where does central bank policy really have a role when it comes to bringing down inflation tied to things that have nothing to do with interest rates?
Well, but those things that are events that are happening that are affecting the prices of goods and services, the inputs, ultimately do show up in the aggregate indicators of the CPI. And it has implications for the things that people buy in the stores. And so the manifestation of these supply shocks end up showing up in expectations, end up showing up being embedded in the prices going forward that firms choose to put on the shelf.
I guess to rephrase the question, to take Tom's trick, there is a feeling that you would have to put so much pain on an economy to bring in inflation, a disproportionate amount, in order to sort of curtail economic activity at a time where inflation is being driven by supply shocks. What's your take on that?
Okay, so you're assuming that the only channel through which monetary policy has an effect on the economy is through the demand side. There's an increasing amount of research, in particular at the UK and Bank of England, that my decisions can have an immediate effect on expectations of firms and households about what they think inflation is going to be. So I don't have to wait for a demand effect to see implications for my decisions on the CPI and especially on CPI expectations. And that, of course, is a key ingredient to the choices of firms' pricing strategies and what workers demand for in terms of wages. So I can have a quick effect.
What a wonderful heritage to have Americans in the Bank of England. There's been a real esteemed set of academics that have gone over there with a different perspective. What have you learned about the reality and impact of dissent at a more fractious Bank of England versus all the Greenspan heritage of the Fed, where we're all on one page, but we're really not? What have you learned?
So I think we can't really compare the Greenspan, everybody kind of getting together, and the kind of, you're saying fractures. I would say more of a debate or oriented Bank of England. The time period is different. The macroeconomic environment is very different. Greenspan didn't have to deal with the same amount of supply shocks that we have had to deal with. And so that debate, I think the other difference is the extent to which research informs policymaking decisions. And I think that research, because the environment is different, because supply shocks have become so much more important, because the great moderation is behind us, that research is informing the policy decisions.
Does Chairman Warsh have to reach out to the hundreds and hundreds of PhDs at the Fed today?
I think they are as key ingredient.
But he's told him he wants a task force because I don't like the research at the Fed. Are you on a task force?
I'm not on a task force.
I could see you on a task force.
Well,
That would be
a
something.
task force to get the kids to college. I am curious, though, to what degree you think it's important for Fed Chairman Kevin Warsh to actually give some sort of reaction function, to actually answer some of the many questions right now in markets?
Well, what I do and what determines my reaction function, how I communicate it, is I tell, I give speeches, right? We have our 200-word paragraphs. What are the data that I'm looking at? It's all very disaggregated. It's a key ingredient. You look at disaggregated data, not the aggregated stuff. Secondly, you have all this research. So telling us, how is the world different? And how does that data translate into how the world is different, how the behavior of the economy is different? And then all that adds up to my decision. I call that, showing what your reaction function is.
Are you going to be going on the hike this afternoon?
Depends on how much it's raining, I guess.
But I hear it's a good
yes.
Yeah, well, I hear it did last year. People are expecting you to as well.
This was successful. We got through it without talking about Harry and Meghan.
Well, until now, basically, you're going to try to jump on this in. You want to get your piece of it?
I'm not
Absolutely fine. Thank you, England Monetary Policy Committee member Catherine Mann. Thank you so much for being with us this morning. It's interesting to see who's here and who's not here. All the Fed officials are here, Tom, except for one, and that would be Jerome Powell. Governor Jerome Powell did not come, and partly out of respect for the Fed chairman, because he doesn't want to complicate the issues. He is perhaps hiding behind the podium, just like he said.
I sat out front. Steve, a picture of this. This is an 8-foot grizzly bear out front of where everybody marches in. And of course, McKee's in the room because he's special, and I'm not. I've never had an invite because McKee has to be in the room. And so I'm sitting there watching the beauty list go by, including Catherine Mann's entourage last night. And the answer is, I'm really impressed with how Kansas City has a cross-section of young, esteemed academics and the ancient academics as well. It's a hell of a turnout for this speech.
Yeah, and right now it is more important than ever to understand the drivers of inflation, the drivers of currency differentials. And coming up next is someone who's been studying it and who is presenting at this meeting, Professor Aswar Prasad of Cornell University, on the dollar, the role of it. We will, of course, have one question on stablecoin, but don't worry, that's what people are looking for right now in any way, shape, or form. From beautiful Jackson Hole, this is Bloomberg Surveillance.
All right. Like I said, I put a position in during the show on DRIP. Right now, DRIP is at 35.56, and my position was put in at 35.56. So I'm right at break even at the moment. And right now, oil is trading at 82.65. Natural gas is trading at 2.891. So DRIP might, if we have a decent sell-off in the energy sector, DRIP might pass 36, might break 36, maybe like 36.10. And then the equity market, the S&P 500, that's trading at 7,744. It's doing decently. VIX is at 1456, so it's just gonna keep on moving up. The equity market's probably gonna do well so far, waiting until Walsh speaks, and he may say something that affects the market. But right now, energy stocks are selling off at the moment. Please go to my store, the-studio-reykjavik.com, and get the structural nail silver toothpaste. This toothpaste will whiten your teeth, freshen your breath, reduce inflammation at the gum line, and help the health of your gum line. It'll neutralize because it has structural nanosilver, so it's great for the cold season, but use it every day. It has no fluoride. It's a very high quality toothpaste. Get a few tubes for your household. Use discount 5 and you save some money. Please go to my store, the-studio-reykjavik.com.
No, it's very complex. And we have two types of fermentation. One is microbial fermentation, and the other is mammalian cell culture. I mean, I basically could have used yeast to make beer, but now I use yeast to make insulin. So
Amazing. I think that actually does it cooler than using yeast to make.
Well, both are cool.
Yeah. No, but one you're saving lives.
Yeah, but the other is also a great.
When you use a tool like Opus 4.7 and the engineers start using it, they go through a learning process, even how to use it. But as you keep using it and you use it long enough, you get very good at it. And then the tools become much more productive. And as you get much more productive, just think about it. You can get one very senior engineer to produce an application design in 1 week, what you would otherwise take 10 engineers and take them 3 months to produce the same thing. The return on investment is still pretty compelling. So to save it properly is a question of the return on investment and what application you're using. But it's also been able to be trained to be able to use it better and better.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism. This week, central bankers meet in Jackson Hole as the bond market struggles to keep up with all that borrowing. 3 former finance ministers tell us why doing the right thing on fiscal policy cost them their jobs. While in Hollywood, the new young Turks of streaming media storm the citadel of the studios.
It is completely taking over the world.
Watch Wall Street Week. More than what you need to know, it's what you need to think about.
Hey investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
I think we need to put some restriction into policy, and so I believe it's time to act for us to do that. The longer that we wait to get inflation under control, the more pain is felt by everyday Americans, and the more difficult it may be for us to ultimately get back down. What I'm seeing is that there's not a lot of restriction in the economy.
That was Cleveland Fed President Beth Hammack. Are there any jobs left? I think that's a good question, considering the fact that we have Beth Hammack and Catherine Mann, 1-2 punch of hawks here at Jackson Hole, Wyoming.
I think it's important.
So the ones that are paying attention, I just put a hedge position now. I'm in Gush and Drip right now. What is happening with the energy market as the equity market is moving upward? The energy market is getting buoyant, and ExxonMobil is moving less negative, and some of the smaller energy companies are actually slightly positive. So right now I just created a hedge strategy between those energy companies. So I'm longing Gush and longing Drip. So I created this hedge strategy.
Has risen significantly since May 22nd when he was sworn in, and a question around just how much this has to do with agita around the Fed's rate.
I'm going to sell this, folks. Everybody's underplaying it. Later this afternoon at Wall Street Time, Lisa Abramowitz with Kristalina Georgieva, and I'm sorry, into the Bangkok meetings. This is a really important conversation of a world turned upside down.
A question about inflation dynamics, a question about trade tensions, a question about fragmentation, and a question about what central bankers' roles are in all of this, especially given the confusion around AI and around, frankly, currency dynamics, which is why I think we really need to get into the conversation with the guests that we have on set. Cornell University professor Aswar Prasad, one of the preeminent scholars when it comes to dual loops, when it comes to the dollar. Aswar, thank you so much for being here. I know you are presenting a paper about stablecoin and how potentially it could increase demand for the dollar. Zooming out the context for this is there is a feeling that the dollar has lost some clout when it comes to being a reserve currency in the world, and you have seen it not react as much as people would have expected in the response to shocks. Would you say that that is consistent with perhaps some of what you're seeing?
So, Lisa, there is very good logic to the notion that the dollar should be getting bounced off its pedestal because of, weaponization of the dollar, macroeconomic policies in the U.S., the policy of volatility coming out of here. The reality is that the dollar has lost some of its safe haven status. Its share of foreign exchange reserves has gone down. The convenience yield, the sort of premium associated with dollar privilege, has gone down. But the other reality is that the world does want safety. Private investors in particular, rather than central banks, are now looking for safety in the rest of the world, and they aren't finding too many other places to put their money. So we still have enormous inflows into the U.S. Equity markets and other financial markets. So there is this sort of tension here. On the one hand, the U.S. remains a dominant financial market, the one that everybody still comes to, but the sense that the U.S. is not as safe as it might have been once upon a time, that is certainly true as well.
And your paper talks about how stablecoin could generate demand for the dollar that just increases its status as a reserve currency. Do you think that there is a tell in the fact that the dollar has weakened since Fed Chairman Kevin Warsh has taken over on May 22nd? Or do you think that that is coincidental because of some of the confusions and turmoil in global markets?
So I look beyond these short-term movements because there are macro factors and policy factors that can drive these in the short run. But the paper that I am presenting here is more than just about stablecoins. Stablecoins already exist, so they are the sort of leading edge of financial innovation. But the key aspect of financial innovation is that it's going to reduce frictions to cross-border asset trade. It's going to make it much easier for firms to raise money in capital markets worldwide. It's going to make it much easier for investors to acquire assets worldwide. And I mentioned earlier that private investors are the ones who are really acting very forcefully right now. If you make it easier for them to get foreign assets, what assets are they going to be looking to? It turns out the answer seems to be dollar assets. So it's in that sense that this combination of financial market depth in the US and financial innovation that reduces frictions to cross-border asset trade might end up reinforcing the dollar's dominance. In principle, it should be creating a level playing field across currencies, but in fact, we might see an opposite outcome.
Okay, I'm going to frame this. I have Kenneth Rogoff coming up later, giving a speech, I believe, at your lunch today. You have Ezra Prasad and Ken Rogoff with us. Is joy. How much is this banker totally focused on his America and his White House? How much is Chairman Warsh missing that he's central banker of the world? I got the idiosyncratic Turkish lira gone. I got Philippine peso up to new weakness. I got every central bank calibrating rate increase or not, etc. How much are we missing in our American selfishness, the rest of the world right now?
So I think it's very important to recognize that what the Fed does, sets the benchmark for the rest of the world. But what the Fed does have a spillback effect onto the US as well in terms of what the market reactions of other countries are and what.
All right, so what I just did was I just closed out my drip position, and I am still in the gush position. So at the moment, for today's trades that I put in, I'm longing gush, which is longing energy companies, and I'm longing oil today. And let that churn. It may go down a little bit. I'll do dollar cost averaging, and then on Monday, set up a new hedge strategy.
And that ultimately will either make Kevin Warsh's job harder or easier. So it's very hard to ignore the rest of the world's reaction to what the Fed is doing, even if you don't directly include that as part of the Fed's objective function.
So you don't necessarily see this as a fragile moment to restore Fed credibility in order to foster more faith in the U.S. currency and U.S. assets. That seems to be sort of underpinning what you're saying, that it's not as at stake as some people might say. Is that correct?
I see this as a hugely fragile moment, Lisa, and there are two reasons why. Number one, what we would like is to have a more multipolar world where there are multiple currencies that are built on strong foundations of deep and liquid, well-regulated financial markets and institutions. We have more balanced currency competition. No country can go, wild with its policies. The other possibility is that because of weaknesses in the rest of the world, you end up with the dollar becoming even more dominant despite all the policy dysfunction that we see here, perhaps not in monetary policy, but in other aspects of policies. So we might end up in a world that becomes very, very fragile. If it is dollar-centric and the U.S. is not, is having erosion of its own policy frameworks and institutional frameworks, that's bad. If we end up with a world where we don't have good multipolarity, where we have fragmentation, and there is no trusted anchor that everybody can hone in on, that's a very fragile world as well. So I think it's a very dangerous moment.
What are you hoping to hear in just about 6 minutes' time from Fed Chairman Kevin Warsh?
I think we all want clarity about the framework, about exactly what the triggers are likely to be. And of course, as a central banker, you need to leave yourself some room to maneuver. But as I mentioned earlier, what the Fed does, how it operates monetary policy, is really the benchmark for the rest of the world. So at some level, the work that the committees that Kevin Warsh has set up that are working on these issues are really crucial, not just for the Fed, but for other central banks around the world. That's why we have so many central bankers here. They want to hear what the Fed is going to do.
Did you sell the movie rights to Hollywood?
I wish I had.
It sounds like a movie.
Who would play the main character? Who would be the main
I think
character?
DiCaprio is something he could pull off.
The Doom will hit that bombed by a major economy. Aswar Prasad, thank you so much for being with us, a Cornell professor who is going to be presenting his paper, The Doom Loop. I actually think that it could be a really good plot. We could really dramatize.
The book is on my coffee table at home, right next to How to Get Your Teenager to Empty the Dishwasher, and it's just a fabulous book.
That sounds like a thrilling reading list right now. It definitely feels like not necessarily a doom loop, but you feel the tension in the air as we await the Fed speech that we are going to get just moments away. Joining us now to talk about it, former Fed Vice Chair Rich Clarida. Rich, thank you so much for being with us. We've talked a lot about whether Fed Chairman Kevin Warsh will err on the side of being hawkish in order to rectify what some people would say is a slight policy error, or at least a lack of clarity at the last meeting. What's your view on this?
Well, we'll find out soon enough. Thank you for having me. At the press conference in July, he indicated he might talk about the big questions, the task forces, maybe the here and now, so we may get a bit of each. But I do think it's important, Lisa and Tom, since we do hear from Beth Hammack and Neil Kashkar and Lori Logan and others about their outlook. I think it's important today that we hear something from the chairman about his framework for thinking how we get inflation back down to 2%.
Does Chairman Warsh need a Richard Clarida? Do we need a monetary policy heavyweight that can spell dynamic stochastic general equilibrium theory? Does he need a Clarida to move forward?
Look, he's surrounded by incredible people, many of whom I know and worked with, and so I don't think he needs a Clarida, but it was an honor to serve for 4 years. I'll leave it at that.
I'm wondering, Rich, right now a lot of people are talking about stablecoin, or pretending to, at least. That is the headline number, or headline topic here in Jackson Hole. How divorced are the academic topics from usually what people talk about in the room when they're looking for a guide on monetary policy?
Well, I think getting stable coins right is important for the next 5 or 10 years, and so I applaud Kansas City for being forward-looking, but I think, as your question suggests, there's a lot of focus, as there should be, on the here and now, and traditionally, Fed chairmen have used Jackson Hole as a preview of coming attractions, and so I think I and you will be interested to see if Chairman Warsh takes that opportunity today.
Rich Clarida is sticking with us to talk with us after we hear from Fed Chairman Kevin Warsh in about 2.5 minutes time. A really compelling moment right now in about the 100-day mark for this Fed Chairman.
Major shout out to Dan Torrance and all of our production teams at Jackson Hole in New York. The conversations we're having, I think, really identify for a global American audience. This is way more than the punditry of what's the Fed going to do at the next Fed meeting, the international ramifications, and just simply what's the plan, I think, is the heart of the matter. This guy has stumbled a couple times. Even his supporters would say that. And he's got to right the ship here and say, in his own way, this is the plan forward.
Yeah, what is the plan? What are we looking at? What are we going to use as measures of both inflation? Is an inflation target as important as it has been in the past?
This inflation says, and Beth Hammock, folks, at Cleveland Fed, 1983, they revolutionized this. Powell liked the Dallas trim mean. There's 14, it's like Howard Johnson's. There's 28 flavors. Somebody, he likes pistachio. The answer is, yeah, we got to get an inflation series we believe in. Right now it's PCE. Maybe it will be new PCE. Who knows?
Michael McKee is sitting by with us as we await this speech. It should be starting in about 1 minute and 20 seconds. Any idea how long it's going to be? Any idea what's in it? Or is this the great unveil that we're going to get?
It's the great unveil. The reporters have advanced, yes, we've had an advanced text.
So for the ones that are watching the dashboard, you're going to see that the euro is spiking up. It's now, there's a little bit of there was a big candle that came up. Same thing with the Japanese yen relative to the USD. And there's a little bit of a candle increase for the equity market, the S&P 500, and also the Treasury, because of this speech that's about to take place. So there's some wild swings in currency at the moment.
Disinflationary, something he's talked about on several occasions.
I think those distractions are there, and maybe I'll touch on them. I think I'll touch on the task force much more, as you have said eloquently. What's your damn reaction function? I mean, that's the heart of the matter.
Yeah, and a lot of people are saying that reaction function and forward guidance are not the same thing, so you can give a sense of what you're looking at. I think there are other people saying it's sort of a slippery slope, if you give a sense. We are getting some headlines right now from the speech. Let's give them to you. Kevin Warsh saying that we have work to do if inflation is not moving to 2% with speed. He said that the Fed's 2% PCE objective is a firm, fixed target. Let's head over and listen to Fed Chair Kevin Warsh right now.
Thank Jeff Schmidt and his team for the incredible hospitality. Everybody here is in debt to you and to your colleagues here at the Federal Reserve Bank of Kansas City. Jeff, our thanks to you and your team. Now, he and the other planners here have some recreation options lined up for later today. I'd advise you to be very careful with your choices. As I learned years ago, you can take 2 different kinds of hikes on the trails around Jackson. I can sum up my hikes with former Vice Chairman Don Cohn with 2 words: I survived. These steely marathon death marches revealed the side of Don that I was not ready for. But there's another kind of hike. This one was with my former Chairman Ben Bernanke, another dear old colleague. With Ben, it was a much more leisurely pace, an easy stroll along the wandering trails of the Rockefeller Preserve. So before setting out today, my recommendation is do a wellness check. Ask yourself, is this a Cohn day or a Bernanke day? The best thing about this gathering is that it helps us all get out here to the mountains and clear our minds and think straight about our world and our time. For me, it feels like the right place and the right audience for a real engagement with the ideas that matter most. Innovation, as Kristen mentioned, is the conference theme. And I believe the public and the markets understand that innovations in the conduct of Fed policy will help deliver price stability alongside full employment. So here's a quick overview of what I'll cover in my remarks this morning. You can call it an outline, you can call it a trail map, but but please just don't call it forward guidance. First, I'll touch on a few of the longer-term questions we're asking at the Fed about the latest general-purpose technology, AI, and where it might take the economy. Then I'll reflect a bit on the practice of forward guidance and the interaction between the central bank and financial markets. Next, I'll present some of the key principles that I believe should guide the conduct of monetary policy. And finally, I'll give you my assessment of what's happening in the economy. So first, I think we should try to prepare a bit for future policy conjunctures. With the unchanging picture of the Tetons as our backdrop, we are here to survey an economic landscape that is anything but static. It wasn't so long ago, including in rooms like this, in the run-up to the crisis of 2008 and over the decade that followed, when economists and policymakers were speaking of secular stagnation, speaking of a global savings glut. It was a widely held view that an excess of capital would sit on the sidelines for a very long time because there just wouldn't be enough compelling investment opportunities. All the good stuff, you'll recall, had been invented. So growth would be low and slow. Well, times sure have changed. We've come to a hinge point in history, to borrow a phrase, a framing from my former mentor, George Shultz. To cite the clearest example, progress in AI, the 80-year-old name for the newest technology, has been faster even than its evangelists predicted just a couple of years ago. The potential for substantially higher growth is on the rise. Ever-expanding pools of capital pouring into AI-related infrastructure of all sorts. A kind of super Moore's law seems to be playing out. Scaling laws, too, are changing both the method and speed of innovation. Capital and labor have combined to create large language models at the heart of AI. Users buy tokens to gain access to these models. Reports put annualized token sales for the two leading labs alone at more than $100 billion, an increase of 500% from just 12 months ago. We at the Fed, we watch all this attentively. We recognize that AI is a new variable, potentially a new factor of production that will have consequences both for the economy and for the conduct of monetary policy. It opens up some major lines of inquiry. Will the application of AI cause a significant sustained rise in productivity across the economy? If so, when? Will token usage be complementary or competitive to labor? Will the next generation of AI models demand even greater capital intensity too? Or will the models themselves help devise a capital-light solution? Among the other yet unknowns is the resulting market structure. Who gets to make the money? It's not obvious where the returns on capital will land, or on what time scale. Early on, how much of the surplus goes to owners of scarce assets? The AI labs, or chip makers, or energy producers, or cloud providers? Over time, how much of that value accrues to businesses and consumers? And importantly, what are the implications for workers and for the employment side of the Fed's mandate? Likewise, we don't yet know the equilibrium price of the tokens that give access to these models. Might there be a heterogeneity of tokens, such that growing sums will be paid for the access to the best models, those at the frontier? Will token prices for older models fall to the level of their marginal cost? Well, we'll be thinking through these matters with the help of a task force on productivity and jobs. My early check-ins with the leaders of that task force and the rest have been very encouraging. To be clear, though, their recommendations will come later and have no bearing on decisions we make in the current policy conjunction. But I believe that for future policy challenges, this intellectual investment today will leave us much better prepared for tomorrow. Next, let me say a word about forward guidance and its substitutes. As our task forces go about their work, As you might know, I'm not waiting to introduce innovations at the Fed to help make us fit for purpose. To highlight one example, I've set out to change the form and function of the Fed chairman's so-called forward guidance. You might know about my longtime discomfort with early pronouncements of future policy decisions. I much prefer another path, and now we'll make the case for it. Transparency in communications about future policy decisions is not an end unto itself. Communications must be in service to the Fed's paramount responsibility. And what is that? That's getting policy right. Forward guidance as a regular practice was adopted by my colleagues and me during the global financial crisis. It was essential at the time, and we introduced it with much fanfare. But as with other legacies of crises past, I believe the practice has outstayed its welcome. In normal times, the role of forward guidance should be limited and circumscribed. Otherwise, it risks creating ambiguity in the name of clarity. Oversharing policy deliberations and overcommitting to future decisions can lead markets, businesses, and households astray. And I believe when policymakers make quasi-commitments on interest rates throughout the cycle, we inhibit our own freedom to make the right calls when it's time to decide. To get policy right, we also need to get the relationship right between the central bank and financial markets. The Fed needs clear market signals, as unfiltered as possible, from market internals, from the level and change in asset prices across sectors, the prices and trading volumes of Treasury securities, the foreign exchange value of the dollar, the cost and availability of credit, a broad set of commodity prices. These and other indicators should inform the Fed's near-term outlook on economic activity and inflation throughout the business cycle. They should also reveal the state of broader financial conditions and the risks and uncertainties of the financial cycle. At the same time, market participants themselves should be tracking real information about the real economy. They should draw their own conclusions, form their own expectations on things like output and employment and inflation, and they too should stay sharply attuned to risks. In my view, the Fed should be humble and never naive. The Fed plays an essential role in the economy and markets. Our tools are powerful. We determine the path of short-term interest rates, and market participants will always try to anticipate what we will do next. But we should not indulge a regime in which market participants are looking primarily to the Fed for their next trade. The economic literature has long described the distorting effects, what it called the Hall of Mirrors problem. If markets rely materially on the Fed's guidance, and the Fed relies on market prices, we're more likely to be blinded to new developments, more likely to be caught unprepared, and more likely to commit errors in policymaking. Now, perversely, market participants are unlikely to bear the biggest costs of the Hall of Mirrors problem. The most serious harm is likely to befall those without any financial assets. If the Fed gets inflation wrong and judges the economy wrong, who gets the worst of it? Not the financial high flyers. Hardworking Americans are the ones left to deal with inflation that's too high, or jobs that suddenly appear less secure. So, if forward guidance is ill-suited to normal times, how about the new Fed chief commits at a meeting just like this to some explicit reaction function? Surely he could tell us his interest rate path, if, say, the data were to come in hot or cold. Well, I wish our understanding of the economy were so precise as to provide a mechanical, tried and true answer. that some simple function, like a Taylor rule, could be rigorously relied upon. But our knowledge just does not extend that far, at least not yet. And other factors most relevant to the proper conduct of monetary policy, they change over time. Providing forecasts to illustrate the Fed's reaction function works better in theory than in practice, better in the lab than in the field. I am not alone in noticing that forward guidance in 2021, to cite just one example, has slowed the policy response to high inflation. In my term as chairman, my colleagues and I will endeavor to construct more reliable models, more robust rules, and we'll do this knowing that accuracy in forecasting is still just an aspiration. With so much changing so fast in our geopolitics, global supply chains, technology, it's wise to be modest about what we can and cannot know as we sit here today. In the same spirit, we should receive the full range of ideas on matters that may inform the Fed's monetary policy discussions. If the aim is optimal decision-making, and it should be, we should not crowd out views on the economy. How then to chart a better path to policy? In the balance of my remarks, I will share with you some key principles that guide my thinking on the appropriate conduct of monetary policy. And then I'll offer my promised assessment of the economy. So let's turn first to principles. First, I've noticed in this line of work, yesterday's news has a way of getting mistaken for what's happening right now. The challenge is to know the difference. In other words, we must interrogate reality. Make sure we're not setting forward-looking policy based on stale or inaccurate data. Nor should we rely on isolated data points. Trends matter most. The Fed's a decision-making agency. We make choices amid uncertainty, and the data upon which we draw must be relevant, contemporaneous, accurate, and as actionable as possible. Second principle. The Fed's actions are intended to ensure that the aggregate demand side of the economy is broadly consistent with aggregate supply. However, all we observe directly is activity. We never see and can only infer what's really happening on the supply side. Hence, evaluating the current and expected balance between aggregate supply and aggregate demand is imprecise. Third principle. There should be no misunderstanding. The Fed's price stability objective of 2%, as measured by the PCE price index, is a firm, fixed target. Let me be equally clear about another aspect of this objective. Price stability is not self-executing, nor is inflation necessarily mean reverting. It's the Fed's job to deliver stable prices, no excuses. Fourth principle. The Fed also bears responsibility for maximum employment. Achieving both sides of our mandate over the medium term is not an either-or proposition. I do not believe the Fed's dual mandate works at cross purposes. After all, high inflation itself is very harmful to economic prosperity. Fifth principle. Short-term interest rates are the predominant tool to achieve the dual mandate. Unconventional policies to spur economic activity may suit genuine crises, of which we all have much experience, but they should otherwise be used sparingly, if at all. Sixth, money matters. I know it's not fashionable these days, but my view is that money has something important to do with monetary policy. We should pay attention to money created by the central bank and money that comes from the banking and financial system. It's true that financial innovations, the subject of this conference, and other factors alter the mechanics that link the monetary base, the velocity of money, and the broader economy. But that is scarcely a reason to ignore the ultimate effects of money on financial conditions and prices. Finally, a quieter Fed, a more purposeful Fed in its communications, is better able to meet its objectives. And we can be held accountable for delivering on our remit, the only true test of our credibility. To borrow a line from General Chuck Yeager, at the moment of truth, there are either reasons or results. So having heard a little bit about AI and general purpose technologies, having heard a little bit about the next policy conjuncture, a little bit on principles, let's turn to the economy today. Given those principles, how do I read the economy? What's really going on outside the window? It's a little ironic, there are no windows in this room, but there are big ones at the Federal Reserve. And we've been using those in my first 100 days, and I expect we're going to continue to use those in the period right ahead of us. Now, you may have read in the July minutes the unanimous view of the FOMC. Labor markets were stable, output solid, but inflation remained too high. A good majority of my colleagues and I thought the wiser course was to await new information in the intermeeting period, especially given possible developments in supply chains, investment flows, and geopolitics, before deciding whether a change in interest rate policy was advisable. And we expressed our joint readiness to act as circumstances require. For my part today, as we sit here, I'm impressed by the overall performance of the economy, which appears to have strengthened. One indicator of strength is how well an economy holds up under stress, how well it holds up under shocks. On that score, both Main Street and Wall Street have been remarkably resilient. Several other observations. Business CapEx is rising rapidly. The 4-quarter change in investment in equipment and intangibles has been around 9%, its highest growth rate since 2021. And more than half of the CapEx growth can likely be ascribed to the build-out related to AI. What about profits? For the firms in the S&P, profits have grown more than 20% over the past year alone. Profit margins are quite elevated relative to history. Overall equity and market volatility quite low. We're staying keenly focused on market internals, watching performance across sectors. Expectations for both growth in CapEx and corporate earnings are running quite high. I continue to watch the change in the growth rates, the second derivative. The follow-on effects on asset prices, business confidence, consumer incomes and spending are equally important to gauge. Credit spreads on corporate bonds and leveraged loans are near the low end of their historical averages. And issue volumes this year, quite strong. Looking beyond fixed income markets to the banking business. In the July so-called SLOOS survey, banks tell us that standards for C&I loans are on the easier end of their historical ranges. That helps explain their growth that we've seen this year in these loans. In my view, credit and loan markets are showing few signs of policy restraint. Now, certain sectors, like housing and agriculture, are showing strains. But on balance, I would be hard-pressed to describe broad financial conditions as restrictive. Real consumer spending has been healthy despite these shocks, increasing more than 2% over the past 4 quarters. If you combine consumption with the brisk investment we talked about earlier, private domestic financial purchases have also risen. These purchases have increased at a pace of nearly 3% or so far this year. That's a measure that typically carries more signal than GDP. The trend here too, positive. So on the employment side of the Fed's dual mandate, the country's doing well. Labor markets are quite stable. The jobless rate at 4.1% remains low by historical standards and hasn't changed much in a couple of years. Unemployment claims on a 4-week moving average, an empirically robust real-time indicator, are near their lowest level in decades. In my view, the relatively low turnover in today's labor market is partly a result of the significant rematching between employers and employees that happened in the post-pandemic environment. But when labor supply is barely growing, monthly job gains are naturally going to run low. There are always areas of concerns in the labor market. For example, among recent graduates. In general, though, people want to work, by and large, are holding or finding jobs. They may well be concerned about future labor disruptions, but as of now, I believe the labor markets are broadly consistent with full employment. But on the price stability side of our mandate, the numbers are more concerned. The Fed's preferred measure of inflation, the one I talked about earlier, the 12-month change in the PC price index stands at 3.7%, with a 6-month change a little above 4%. The comparable measures from the CPI index are also elevated, as are core measures both of PCE and CPI inflation. And none of these measures are perfect, but they all tell a similar story. Inflation is running above our 2% target. So the Fed's predominant focus right now should be on prices. So what's our job? The job for policymakers is to capture underlying trend inflation. Easier said than done. We want to gauge whether underlying inflation is rising, falling, or seems to be stuck in place. We also want to understand not just the direction of travel, but the speed. Each of these broad inflation measures have fallen significantly from their highs of a few years ago, but progress in the last couple of years has been more modest. And while this summer's PCE and CPI readings were better than expected, they do not tell me that underlying trends have meaningfully improved. The data also show moderate wage growth, but in my view, when tracking underlying inflation, wage growth has not proven a reliable indicator of future inflation for a very long time. So to try to gauge underlying inflation, I want to tell you about a couple things I've always looked to. I find it instructive to disaggregate the 199 individual components of the PC price measure. Over the last 12 months, 54% of goods and services in this basket showed price increases above 3%. This is well below the post-pandemic highs of about 77%, but it remains well above the level of 32% in a couple of the decades that preceded the pandemic. Looking over just the last 6 months, the conclusion is similar. 49% of goods and services in the PC basket showed price increases above 3%. Again, this is well below the post-pandemic highs, but still elevated, quite elevated. The recent rise in overall commodity prices also bears watching. What we need to judge is whether the trends we see indicate upside inflation risks. Now, it matters too whether the inflation readings of the past 5 years have seeped into expectations. The good news is that measures of inflation expectations in the medium term, by and large, look stable. And inflation compensation measures from the swaps market send a strong and similar message. Especially in light of recent developments, it's a credit to the Fed as an institution, consistent with the best of the Fed's traditions, that market prices show confidence that we will deliver price stability. And I can assure you, they're right. The thing about market measures of inflation expectations in economic history, I know some economic historians in the audience, is they all tend to look really strong and durable until they don't. These expectations are not pushed around easily, and right now they are very well anchored, but they must be closely minded. And it's the Fed's job to make sure that inflation expectations do not get unanchored. Now, there is one signal nobody can miss: the responsibility for 65 months of sustained elevated inflation sits squarely with the central bank, and that's where it belongs. So here is my standard. We must be confident that underlying inflation is moving to our objective, clearly and at sufficient speed. Otherwise, we have work to do. That's our job, that's our mandate, and that's our charge to keep. So I've covered quite a bit of ground in the last 25 minutes or so. Let me see if I can conclude this way. I stand here today committed to a discipline, not a decision. My Fed colleagues and I are hardly the first to hold these positions in a time of great consequence. We are determined to redeem the time by doing our very best work. For those of you that know us, you'll know the following is true. We take our responsibility seriously, with humility and with resolve. We know so much depends on the choices we make. Sound monetary policy helps households and businesses to prosper. When carried out effectively, it broadens and deepens the momentum of our economy and helps to secure America's leadership in the world. And I know that our country needs us to think carefully and act wisely, perhaps now more than ever. It's a tremendous honor to serve once again at the Federal Reserve. I'm truly grateful for the encouragement, good counsel, and the warm reception I've received in my first 100 days from my colleagues. I'm also honored and grateful for the views that I've gotten, solicited and unsolicited, from so many of you in this room. For that, and for your kind attention this morning, I say thank you. Let's get on with the rest of the program.
That is Fed Chair Kevin Warsh wrapping up his Jackson Hole remarks. This is Bloomberg Surveillance on television and radio live from Jackson Hole, Wyoming. If Fed Chairman Kevin Warsh's goal was to be hawkish, it was Operation Success. He really did say the key line at the end, here is my standard. We must be confident that underlying inflation is moving to our objective clearly and at sufficient speed. Otherwise, we have work to do. That's our job. That's our mandate.
It was very Warsh speed.
Now, there was a lot of movement in the equity market, the bond market, the currency market, not so much in the energy market. So before we dive into what was going on in the different asset classes, let me just plug a couple products here. Please go to my store, the-studio-reykjavik.com. Get the probiotics. You can get it in veggie cap form or in the powdered form. And with a good probiotic, you're improving your gut biome, you're reducing inflammation, boosting up the immune system at the gut level. You're also improving metabolism and brain function. Yes, a better gut biome is going to help with brain function, and it'll help you to sleep better and get rid of brain fog and let you concentrate better. Digestive enzyme complex helps to break up carbohydrates, proteins, and lipids. You're reducing the load on your pancreas, and it'll allow you to absorb your nutrients with less stress. This is super important to take if you're 40 years of age or older, and digestive enzyme complex has bromelain. Bromelain is important in breaking up proteins, but also breaking up clots. Olive leaf extract, dual purpose. It's going to help with your immune system and your cardiovascular system. It's going to bring down inflammation and help you to control your lipid profile. Structural nanosilver gels. You can get it in tube form or in the quick dispenser. We're going to get into the cold season. You're going to need this. This neutralizes. You can use it as a daily skincare. You can also put it on a cut, an abrasion, or a minor burn and help to heal it quicker. And during the cold season or allergy season or just cleaning around the house, lightly coat your nostrils and it'll stay active for 5.5 hours. And it'll help to neutralize and protect. Super important. Especially with households that are sending their kids to school, you're going to need the structural nanosilver. C60, you can get it in MCT coconut oil, extra virgin olive oil, and avocado oil. C60 is a very potent antioxidant. It'll soak up free radicals, boost up the health of your mitochondria. You're going to have more energy. You're going to be able to recover quicker after a workout, Take a teaspoon a day, every day, preferably on an empty stomach in the morning. And it's going to soak up those free radicals, help boost up your immune system, your endocrine system, help reduce plaque formation at the vascular level, and help with brain function. Because by bringing down inflammation and soaking up free radicals, your neurons work better. So please go to my store, get the C60, take a teaspoon a day every day. I've been doing this protocol every day for over 10 years. Teaspoon a day, every day. Please go to my store, the-studio-reykjavik.com. Use discount 5. You save some money. It's all caps, discount 5. You can use that discount as many times as you want. Please go to my store, the-studio-reykjavik.com. The link is in the description of this video.
But this Fed chair was prepared to hike rates in the face of 65 straight months of above target inflation.
Oh, I think so. I think the work to do quote that you mentioned is the money quote, and I think that it delivered the reaction that the chair wanted. In particular, he also highlighted that the recent improving inflation data to him did not represent, he was not confident that was the trend. And so I think every meeting, including September, is live. But I think also that's about as much as we're going to get out of the chairman in terms of his reaction function, that there may be work to do.
I was surprised that he leaned so heavily into the 2% PCE objective is a firm, fixed target. And the fact that we did hear from the Fed chair granular analysis of the components going into PCE and how broad-based inflation was. Rich, does that give you a sense that maybe this isn't somebody looking to overhaul inflation measurements, inflation targets, the way some people were expecting?
I think my interpretation is the chairman wants better measurements and better forecasts, but he made clear that the target by which the Fed will be judged is the existing target, which is 2% PCE inflation, which of course there was some confusion about that coming out of the July press conference.
Rich Clare and I remember interviewing Christine Lagarde here, and she was quoting Ernest Hemingway about the spirit and vision of America in this Wyoming. So I've got a chairman quoting Chuck Yeager. At the moment of truth, there are either reasons or results. Rich Clare, is that what Ph.D. monetary theorists want to be lectured on, to get reasons or results? Isn't it about process?
Well, ultimately, you hope the process delivers the results, and the chairman is correct that for the last 5 years, inflation in the U.S. and around the world has been above the target. And so he's focusing now on what the Fed needs to do to get it there. And in particular, as I mentioned, highlighting that some of the improving data that we've gotten since July, at least to him, does not indicate a material trend. And so he and the committee will be looking for additional improvement. And if they don't get it, I think they're prepared to hike.
Rich Clare, thank you so much for being with us, and congratulations on missing out on the hike this afternoon that I hear some people are expected to take, even though it is currently absolutely pouring out there. Thank you again. That was the former Fed Vice Chair, Rich Clare. Joining us now on set, staying dry under our tent, is, of course, the wonderful Kate Moore, City Wealth CIO. What did you make of the speech? Was it what a lot of people wanted from the market?
Yeah, I think Warsh delivered on what the market participants wanted. Number one, he gave some view of the economy, which I think was important. He indicated that it was strong, it was resilient. That's how we all feel. I love that he talked about profits, because that's incredibly important for us as investors. I love his commitment, once again, to the 2% inflation target, reiterating that that's something the Fed is laser focused on and not backing away from. And I think, you're seeing this sort of stability in the equity markets because we got what we needed from this speech.
Stability in equity markets, even if there is a hike. I mean, this is sort of the interesting note. You are seeing the expectation for a Fed funds rate hike for the September meeting go from before the hike as something like 35%, or before the speech to something like 35%. Now we're up to about 50%.
Yeah.
Is this acceptable right now? That's not necessarily going to take the froth out of equity markets.
Look, I think we should all expect September is a live meeting. We like the kind of 50-50 probabilities at this point, because we don't exactly know how the data will come in, especially the CPI print that'll come in a couple weeks.
I don't think the equity market is as sensitive to higher rates as the economy is. And I think that.
All right. The currency market moved a lot during the speech from Warsh. Euro is weakening, the dollar is strengthening. It's trading at 1.16, but another big move, which is going to affect the Japanese market and the BOJ, is the movement on the yen. Dollar strengthened, Japanese yen weakened. And that's trading at now 159.88. It was trading almost at 160. So there's probably going to be another intervention in the market. Bottom line is that his speech signaled a tightening because of inflation, which I've been saying for a while. That's the better way to go. I've been saying this for more than a year and a half. To do the right thing long-term to raise rates. Short-term, it's going to affect mortgages and car loans and business loans. But we need to control this inflation issue that we've had for way too long. Now, that's very positive for strong dollar. Now, there was a big move where actually the 10-year bond price went up and then went down, and now it's stabilized. So the yield on the 10 and the 30 are now at 4.68 and 5.18 for the 10-year and the 30-year respectively. So the 10-year dropped as low as 6.662, and now it's trading at 6.698. So, it was somewhat, it definitely was reactionary to the news. Now it's trading at 4.7. It seems as though with the news announcement that the 10-year yield is moving up. But what is interesting is the 30-year is actually trending down. So you have a curve that's like this. What's happening is that the back end of the curve, the 30-year, is actually coming in. And we may actually have a more of a curve, the curvature of the yield curve may be increasing. And with him signaling that rates are going to go up, the front end of the curve is going to come up. And so we may actually see a flattening of the curve here. But we'll see. We'll see what happens. Now, in terms of equities, it sold off and then came back up. Now it's trading at 7,747, and Gush is trading at 43.49. Drip is trading at 35.92. Natural gas is trading at 2.871, and oil's trading at 83. What was interesting was the Bitcoin sold off, and then since the speech ended, it started to go back up. And now it's trading at 79,720. So if the Federal Reserve is raising rates, there's probably going to be a sell-off on Bitcoin. So that was the reaction to the news. There were some big moves in the currency market, which was not so surprising, but definitely something to watch out for, especially if you're trading currency. Dollar is strengthening. So with that, please go to my store, the-studio-reykjavik.com, and get the lignans. Lignans will help with your immune system and your endocrine system, soak up free radicals. It's going to bring down inflammation. You're going to be able to recover quicker after a workout. Ashwagandha root controls cortisol levels and blood glucose levels. That's going to help with your immune system and cardiovascular system. Turmeric brings down inflammation. That's going to help with the immune system, the endocrine system, your brain function. You'll recover after a workout quicker. They'll help with your joints if you have arthritis, and also your cardiovascular system. Now, you can take these separately, but I highly recommend that you take them together. They're synergistic, and it'll help to slow down the aging process. Take the turmeric, the lignans, and the ashwagandha, and you're targeting in different ways to help improve brain function, the immune system, endocrine system, and your cardiovascular system. And when you do this on a regular basis, you'll have these compounding effects, and you're going to actually slow down the aging process, and you'll be methylating your genes less. See, part of aging is your telomere lengths shrink, and you have higher methylation, and your epigenetics change. But if you can keep that inflammation down, soak up those free radicals, improve your different organ systems, those tissues are healthier, and the telomere lengths on average are longer. The methylation through aging is less, and over time, you're actually aging slower because of it. If you have high inflammation, high free radical load, your energy levels go down, tissue damage happens, and you age faster. So we're trying to reverse that. So this is the reason why stacking this is really important. So get the turmeric, get the ashwagandha root, and get the lignans, stack them together. Very powerful stack to help slow down the aging process. The structural nanosilver lozenges. We're going into the cold season. You can get the orange splash, fortified with vitamin C, and the manuka honey. Get a few bags for your household. You never know when you need them, but they're perfect for the allergy season, the cold season, and also cleaning around the house. You start feeling that irritation when you're around dust or cleaning in the yard, take them right away and mitigate the problem. And it will help to neutralize because it has the structural nanosilver. So please go to my store, the-studio-reykjavik.com. The link is in the description of this video and all my videos, and get the great products that I offer. And when you use these products, you're actually going to get healthier. You won't need a physician as often, and you're going to be aging slower. It's a win-win. You're helping support the channel, and you're taking charge of your own life. So please go to my store, the-studio-reykjavik.com.
Cluster, earnings growth,
right,
incredibly high revenues, raising guidance. I mean, that kind of momentum is not going to be derailed by a couple 25 basis point hikes at interest rates.
That's right where I wanted to go. And the heritage of this folks is Bill and Bauer, Catherine Mann, who was just with us now with the Bank of England, driving Citigroup Economics. And now you've got Andrew Holloway, who was way out front on higher rates and somehow will survive that. What I didn't hear in that speech was a discussion of the buoyant nominal GDP we're living now.
Yeah.
And the stock market is looking at nominal NVIDIA GDP and saying we can handle Warsh's higher rates.
We can, and look, we're really constructive on productivity growth. I think that's an important message.
Now or 5 years from now?
I think now to 5 years from now. Of course, forecasting 5 years from now is incredibly difficult. But we are seeing productivity growth. We think we're going to see more of it over the next 12 to 24 months. And I think some of that's getting priced into not just yields, but obviously into equity expectations as well.
Right now, there is a feeling that Chair Warsh is impatient. You are seeing this in markets if you are just joining this. The key line was when Fed Chair Kevin Warsh came out and said, "Here is our standard. We must be confident that underlying inflation is moving to our objective clearly at a sufficient speed. Otherwise, we have work to do." Does he lose the credibility if the FOMC does not hike in September?
I think the Fed needs to continue to be data dependent.
What does this mean? Because we just got data and it was disinflationary. Does that mean they don't hike? But
we know we're looking at a several month trend in terms of the inflation. And I just a lot of comfort from the message today that it's not going to be about a single print, that it's going to be about this kind of moving average, and that the Fed is committed to 2%. Look, if they don't hike at all in the balance of this year, I think they lose a lot of credibility. If it's September or October or later in the year, you know, I think we can split hairs over that. But no hikes at all after this type of message would be a challenge. But September in and of itself doesn't change the credibility of the Fed. They need to take back the 75 basis points of hikes that they delivered after the last FOMC meeting here in Jackson Hole. I mean, there's a lot of stuff that needs to come out. And of course, we have to bring into the conversation the fact that we have midterm elections. And although the Fed is going to be apolitical to the extent that it can be, we do know that consumer behavior sometimes changes ahead of elections, and that there's going to be a lot of noise. I expect a decent amount of volatility in the equity markets over the course of the fall because of policy, because of earnings, and because of the elections.
Kate, stay close. Michael McKee just ran out from the room. It is raining. He somehow managed to avoid getting completely soaked. You were in the room. You heard the speech. What was the main feeling in the room as he was delivering a speech that frankly delivered a lot of what the market was hoping for?
Well, it's very hard to read the room because everybody is quietly listening to him. I looked at a couple of Fed officials who were watching the speech, and I didn't discern any kind of reaction. But I think even though he did not pledge that they would raise interest rates in September or beyond, he satisfied investors' concerns today. And you can see that in the futures market. In the 2s and 30s, the yield curve has flattened. And what we're seeing is basically the market saying, okay, that's what we wanted to hear. We want to know what your view on inflation was, and it's not good. And we want to know that you're committed to doing something, even if you're not saying you're going to raise rates, to bring it down to the 2% target.
I mean, I'm glad you quoted the monetary theorist Chuck Yeager. That was great to see. But Michael McKee, did you learn anything about his process forward? I did not.
Oh, I think we did, in the sense that he is not completely familiar to everybody because he's been out of the Fed for 15 years. And a lot of people have mined his previous work to see what he thinks. But he is looking at a variety of data, and what he's looking for is a stable view of where inflation is and is going. Right. So he's looking at that kind of data, and if he gets that, he's happy, but it could be improved.
Let's keep the show going right now. I need an umbrella. Can I get an umbrella right now, please? I'm seriously, can I get this?
It's getting a little bit.
I did this with Alan Meltzer, Carnegie Mellon, a number of years ago. I'm looking for an umbrella for my team right now. They're all dry, so they don't get it's raining on Lisa Abramowitz, but not on you. So I'll go to you, Ellen, straight now. The deluge that Abramo has right now. The heart of the matter, to me, within your responsibilities as a Citigroup, is the stock market can put up with this. That's all there is to it. There's all this navel gazing, and the stuff McKee lives on. And the answer is it's one big so what for the equity market.
I think the important point also from the speech was Warsh indicating that he didn't see any signs where financial conditions were restrictive at this point. And that is the experience of almost every company we talk to in every industry. They're saying the same thing. There's nothing in the rate environment that's restricting their behavior. And since we know so much, oh gosh, so glad the umbrella's here. Hopefully the story passes quickly. I'm fine. Really, I'm fine. You still look great. Thank you. That's the most important part.
I did this for Alan Meltzer 15 years ago.
So you're just trying to recreate the incredibly joyful memory. It seems like people are unfazed right now in terms of the potential risk appetite. It does seem, though, like we did get a sense of why he wasn't explaining why the Fed remained on hold. He said that sometimes giving a sense of what past policy was or giving past history is misconstrued as what's going to be coming ahead. What do you make of that in terms of not even giving the rationale to why the FOMC makes the decisions that they do?
Well, I'm going to take this back to how I think about the investing framework in general. Because I always say to my analysts and people that work with me that you cannot drive the car by looking in the rearview mirror. And it's so frustrating when people say this is a historic relationship between these stocks or between this economic data point and the market, and then they try and project forward. So I have great sympathy with this overall sentiment that taking historic data or historic precedent experience and then trying to project that out into the future is a failing game. I did love also that Warsh talked about AI, token usage, and how that's really affecting large parts of the economy. And of course, again, going back to this productivity point, well, effectively
I think help drive productivity in the future, the adoption of these tools. As the Chief Investment Officer of City Wealth, when you hear this kind of speech at a time coming off all of the angst that we had been feeling in markets, does it give you more conviction to go into long-term U.S. bonds, to go into U.S. assets and overweight some of the U.S. instruments over the rest of the world?
I mean, that's a tough question. I'm going to separate out the bonds from the equities. We have been significantly underweight duration for a considerable period of time, the entire duration of my 18 months as city CIO. What I will say is I feel very little reason, given the fiscal backdrop, and really no impetus to add to duration or to add to our underweight bonds. What I do feel highly convicted in is the underlying growth story, the breadth of that growth, how it's impacting CapEx in many different sectors and industries. I feel really good about our U.S. equity stance and continuing to lean into the secular earnings growth.
Okay, I want to bring in Kate Morgan and Michael McKee on this. So Michael McKee, I've got an expert on the 5 and 10-year, 20-year lag history of productivity, and you're worried about what are we going to do with earnings ending September 30. So productivity is the great salvation of Besant. The bottom line is we're going to do a Besant methodology, which Druckenmiller pushes against, because productivity is going to come to the rescue. Mike McKee, what is the evidence that productivity can come to the rescue?
Well, there's no evidence, if you're talking about AI productivity, there's no evidence in the data yet. There is a supposition based on what AI could do to raise productivity, but we really don't have an idea of how much that will be. Obviously, the AI proponents are saying this is going to be a game changer and it's going to do a lot.
Right.
We had the same thing happen, of course, in the 1990s with personal computers, the old Robert Gordon saying about productivity is everywhere except in the data. It takes a while because companies have to learn how to use this tool, and they have to restructure their companies to do it. So we're not going to have any benefits for Kevin Warsh and productivity and holding down inflation for some years.
Okay, so the giant Northwestern had a lot of caution in the 90s. Howard out of UCLA is skeptical, I'm sure academically. We don't really know where productivity is going. What would you say to Secretary Treasury Besant right now about this big gamble on productivity?
I'm more constructive on productivity because although it's not always showing up in the data, and Michael's making a great point here, the conversations we're having with companies indicate that in significant pockets of their business operations, they are actually seeing efficiency gains. This is what I would also say. We're talking, obviously, we're here in Jackson Hole. I think it's going to clear for us at some point.
50-50 chance.
But we also got the G20 finance ministers meeting coming up this weekend as well, where Secretary Besant will be there. And I'm very interested to see how he talks about both the interventions from the Treasury and then future expected behaviors, because this is going to be a lot for the market to digest. We got good news, I think, from Warsh, as Michael was saying as well. We got all of the boxes checked that we needed to hear, and now we have to get a sense for where other parts of the policymakers are going to play.
Catherine said a great point. Mike, you and I were talking about that this morning. It's pretty unusual to have an event scheduled so close to the Jackson Hole meeting, where it really is a conflict of schedule for so many of the people who would normally be here. I mean, the G20 taking place in Asheville, I believe, on Sunday.
Yes, it's obviously inconvenient for both sides, but we haven't seen that before in terms of the scheduling. I don't know why it was scheduled that way, but a lot of the central bankers who might ordinarily be here are not coming because it's too much to go back and forth.
Well, I know that, Kate, you are here because you have a home here and you very much love this, as we do we. I'm just curious, for you, walking away from this, did it seem like a big market moment to you? Do you think that this was a pivotal speech that will go down in pantheons of Fed chair speeches, like the Payne speech and like some of the others that potentially kicked off an era that we can reflect upon?
Oh gosh, I wish I had that crystal ball. What I will say is, again, I'm going into the rest of the market trading day into next week feeling comfort, from all of this. I want to say I also know that Chair Warsh is a big fan of Jackson and the Grand Teton National Park. I loved how we talked in the beginning about the two different types of hikes that we can do, and I hope certainly that the weather clears so that participants here can get out a little bit. It's beautiful country.
Kate Moore, thank you so much. Wonderful to see you as always. Kate Moore of Citigroup and Mike McKee, thank you as always for all the context and wonderful insights. Yeah, we heard about, you remember Paul Volcker. He showed up famously late to the dinner the first year, to the Thursday night dinner, wearing his fly fishing outfit
in a carefully orchestrated moment where he was trying to demonstrate his love of the outdoors.
Well, he knows the history better than me, but basically the reason this started for the Kansas City Fed as part of their district was a bribe to get Volcker to show up simply because of fly fishing. Right. And basically said, how can we get Volcker here? And the answer was fly fishing. Let's put it in Jackson Hole.
If you wanted to fish for a hawkish...
Built on value, inclusivity.
Please go to my store, the-studio-reykjavik.com, and get the vitamin D3. This will help with gene expression because vitamin D3 is a gene expression cofactor. Vitamin D3 also helps with the immune system by getting cells to go into apoptosis if they're infected, so it's very important to take during the cold season. And vitamin D3 helps to build denser bone. And vitamin D3 works synergistically with K2, MK7 for your cardiovascular health. So please go to my store and get the vitamin D3. And vitamin D3 works even better when you take the magnesium from my store. Clarity factor. This will get rid of brain fog. This will allow you to concentrate on tasks and over time improve your speed of thinking and your memory. Over time, by taking this NeuroStack, what's going to happen is that your dendritic connections will improve, your neural connections will be stronger, and you'll be thinking faster. This is a great way to improve your brain function and to be able to concentrate on tasks at work or at school or even at home. Really important. And get the zeolite. Zeolite will remove toxins, chemicals, heavy metals. Take 3 small drops underneath your tongue, drink filtered water. Do that daily, and you're detoxifying your body. This zeolite you can take daily. Now, it's also important to drink filtered water, stay away from processed foods, and make sure you clean your environment. If you have a lot of cleaning supplies and paints in your home, put it in double-layer containers so they don't degas as often, so you're not breathing it in on a regular basis. Really important. So please go to my store, get the zeolite, the clarity factor, and the D3. And it's a great way to detoxify your body, improve your bone density and your cardiovascular health, and improve your brain function.
Chairman Warsh and his speech. And later in the hour, we're going to hear from Bank of England Governor Andrew Bailey. He's going to speak with Bloomberg Television anchors Tom Keene and Lisa Abramovich out in Jackson Hole, and we will bring that to you as well. So a lot going on in the next hour. We're going to kick it off with Charlie Pellet in a Bloomberg Business Flash. Charlie.
Hi, thank you very much, Paul and Judy. And right now we do have the S&P 500 index best level of the day. S&P is 77.70 now, up 39. Fed Friday up 0.5%. Our Jackson Hole coverage will continue. Dow Industrial is up 226 on the Dow. That is a gain of 0.4%. Nasdaq up 56. Nasdaq 100 index up 0.3%. We got to tell you, not all stocks taking part in this rally. The Russell 2000 index of small cap shares down by 0.5%. 2-year 4.29%, but the 10-year 4.67%, but 30-year.
Right now, the energy stocks aren't really participating in the equity market rise. The equity market for the S&P 500 is trading at 7,768. I still have a year-end target of 7,800 to about 8,000. But be careful because of the AI bubble. Be careful. There's going to be a rush in equities because of what Warsh said. And the question is, how stable is the AI trade? I don't think it's too stable. Now, for ones that have been paying attention to me, watch the SSG ETF to short semiconductors. That's trading right now at 11.98, and USD is the long for semiconductors. USD, all right, it's an ultra long for semiconductors, and SSG is the short. Now, I personally think that the AI bubble is approaching a burst. How long it takes, maybe it's Q4, maybe it's Q1, who knows? But I think the circular financing and the questionable profitability of Anthropic and OpenAI could lead to a downturn in this AI trade. Anthropic has not proven that they can make money. They can get revenue, they can spend, but they spend more than they get. So OpenAI and Anthropic, the two biggest customers for the hyperscalers, are not profitable. How long can that last? So that's why I'm looking at SSG, and right now it's trading at 12.005. Now, during Warsh's speech, it did tick up a little bit. It went as high as 12.21. So, you know, we probably have a trading range at about 1150 to about maybe 13, somewhere in there, while we're waiting for this burst to happen. Now, if you are very positive, if you're very bullish about semiconductors and the AI trade, then long it by using USD. But SSG, that's a short. It's not. It's too early to short it, but it's coming. So pay attention. This is another way to hedge if you want to hedge your equity positions, because when the AI bubble does burst, I suspect that there's going to be a big drawdown on the S&P 500 and the Russell 1000. And what's going to happen is that a lot of stocks, even if they're not tied to AI, are going to get pulled down, at least in the short run. Well, a way to hedge that is when you're seeing this happen, put some positions in SSG to make some money, and then take that money that you made in SSG and roll it back into the S&P 500 or Russell 1000 and buy in while it's selling off. So you're making money shorting AI stocks and rolling it back in to get better dollar cost averaging. That right there is a great way to weather the storm. Now, again, my whole show is predicated on this idea. You take control of your life. The government's not going to take control of your life. It's not going to be able to help you when you need help. And physicians aren't going to help you when you really need help. Physicians don't care about your health. They care about your insurance paying on time. Governments don't care about you. They care about you paying your taxes and making sure you vote for their party. That's all they care about. It's only you looking in the mirror and saying you are going to take control of your finances and your health. Government's not going to do it. Physicians aren't going to do it for you. So if you pay attention to me, you are going to be able to take control of your life. It's that simple. So please go to my store, the-studio-reykjavik.com, and get the great products that I offer and listen to these positions that I talk about all the time. And you will start to get the confidence to be able to supplant your income from working for someone to working for yourself. Because again, your employer doesn't care about you, the government doesn't care about you, your physician doesn't care about you. The only one that's going to care about you is you. You're going to have to look in the mirror and decide, are you going to take charge of your own life? Stop believing in this idea that when the market starts falling, that the government's going to be here to bail you out. They're not going to be here to bail you out. They're only going to bail out the billionaires and the multimillionaires. They're not going to help the average citizen. The average citizen is not going to get any relief. And when you're really sick, if you're really having a problem, what happens? The bills keep on piling up for care. So it behooves you to actually pay attention to what I have to say. It will help to make your body stronger and healthier, and you'll be able to be more self-sufficient financially. So please go to my store, the-studio-reykjavik.com, and get the Gladiator Barley. Gladiator Barley will help to build muscle, detoxify your body, bring down inflammation, and soak up free radicals. And when you do that, you're getting healthier. And yes, when you build muscle, you're actually improving your brain function. Why, Dr. Paul Cottrell, does building muscle help with brain function? It's easy. That's an easy answer. You build higher concentrations of myokines and higher concentrations of BDNF. Those are all neuroprotective. So that means your neurons are going to be healthier. So build some muscle. You don't have to look like Arnold Schwarzenegger. And by detoxifying your body, bringing down inflammation, and soaking up free radicals regularly, you're slowing down the aging process. You're helping with your immune system. You're helping with your cardiovascular system and brain function. Just by taking this every day. Now, you can also take the heirloom barley. Now, what's the difference? It's basically the same thing, but this doesn't help to build muscle. So if you don't want to build muscle, take the heirloom barley. It'll detoxify your body, bring down inflammation, soak up free radicals. You get all of that in Gladiator barley, plus it'll help to build muscle. And it stacks really well with Myotrol, which helps to build muscle also by helping with the gene expression. Now, Boomer Boost can be used as your multivitamin. Now, what this will do is it'll give you the multivitamins you need, the minerals you need, and other supplements that help with slowing down the aging process, boosting up your energy levels. You'll have a steady burn of energy. It's going to help to control your A1C levels. It's going to help with your immune system and endocrine system, help with your cardiovascular system, help with musculature, help with brain function. And by taking this every day, you're going to notice that your body is improving. And that's because of all these different systems are actually getting into homeostasis. So take the Boomer Boost every day, and you can use this as your multivitamin. So please go to my store, the-studio-reykjavik.com. Use discount 5 and you get $5 off any order. I want you to save some money. I want you to pay attention to me and make money in the market. And I want you to get my products from my store and get healthy. Because the government doesn't care about you. Your physician doesn't care about you. Only you will care about you.
He also said, well, inflation's too high, and we need to see it coming clearly back to target and coming back to target at the required pace. So I think you can kind of distill a couple of lessons on his reaction function from that. Firstly, he doesn't like inflation above target. Secondly, he needs to see inflation moving back towards target sufficiently clearly and sufficiently rapidly. Otherwise, as he said himself, the Fed has work to do. He didn't quite say it, but I think the markets have interpreted work to do as rate hikes.
And we're starting to see that 2-year yield up 8 basis points to 4.31%. Tom, thanks so much for joining us. Really appreciate getting a couple of minutes of your time. Tom Orlick, he's the chief economist for Bloomberg Economics. He's based down there in Washington, D.C. Let's head back out to Jackson Hole, but for a dry Jackson Hole. That's because Tom Keene has found a shelter. He's in from the elements, and he joins us right now. Tom Keene, co-host of Bloomberg Surveillance. Tom, I'm glad you guys found some dry ground here. I'd love to get your thoughts here on what was an eventful morning for you guys out there in Jackson Hole.
Eventful morning, I think we've covered it a lot, but what really matters now, Paul, is the opinion of Wall Street. I'm reading some of the research notes coming out right now, pretty much the same tone, which is this is a more restrictive, Kevin Warsh is the chairman, not throwing a bone, but clearly tilting towards the obvious length of the inflation trend that we've seen. I'll let the markets decide what the betting odds are on this meeting or the next meeting or that. But the clarity here is surely homage to a more restrictive Fed. I didn't hear much dovish there this morning.
Tom, quick question about the pricing in of a September rate hike. So you talked to me a little bit about what it would require for that rate hike to happen or the chances of that
good question
to go up.
Yeah, this is a really, really important question, is if we've got the betting, the parlor game of what the Fed is going to do, what's the data that's going to matter. There's no question the data is inflation data. We had a jobs redo, if you will, today that didn't even make the headlines. It was pretty much a non-event. But clearly there's a tone there of a fully employed America, which so many of our listeners and viewers would aggressively disagree with. I had a kid last night, point blank, tell me how difficult it is for recent college graduates to get jobs. So they're going to look at the inflation data here to confirm an excuse to stay where they are, or maybe even to raise rates. We certainly heard from many, including the president of the Cleveland Fed, raising right now.
Tom, one of the, I think, objectives a lot of folks hoped that Mr. Warsh would achieve with the speech is maybe regain a little bit of the credibility that he may have lost in some people's minds from his initial communications with the market. From the folks you're chatting with out there, do you think he did regain some of the credibility that perhaps may have been lost?
Yes, a good question, because it was so dire that he had nowhere to go but to turn it around. And Paul, I'll give him immense credit for that. He clearly turned it around, as Tracy Alloway said, with a record length of speech here at Jackson Hole. It went on maybe 9-10 paragraphs more than what I expected. So yes, I think he improved his credibility, but I did not hear much, Paul, of process. I didn't hear much about the mechanical nature of how he wants to take less visibility, less chit-chat, a quieter Fed, and then what is that process to get to a decision? I didn't hear much on that.
And Tom, I guess we didn't hear much on the various committees, working groups he set up to look at various working aspects of the Fed. So that's something we guess we'll have to wait for.
His team was listening to you yesterday, Paul. There was a dreaded task force that came up. I think I can state nobody out here is offended that they're not on a task force. I'm not sure what task force will do. Of course, you know, Paul, we do have the surveillance task force led by Alexis Christophorus, which keeps us on the straight and narrow.
All right, Tom, stay dry out there. Hopefully you guys will get your afternoon hikes in. I would recommend that horseback little tour. That was fun when I did that. Tom Keene, co-host of Bloomberg Surveillance Radio, is out there in Jackson Hole, holding court like only Tom Keene can do. The $1 Million Cowboy Bar, that's the place to be.
What makes it $1 million?
It's huge. It's got everything in there, live music, pool tables, just a restaurant bar, the whole 9 yards, and the bar stools are saddles. So you just hop into a saddle. And Tom Keene, I will find this photo. It's out there in the zeitgeist, as Tom would say. There's a picture of Tom Keene in his trademark double-breasted suit and bow tie sitting on this bar stool. I mean, talk about fish out of water spot, but he holds court up there, so it's good. And he gets his breakfast at the Pioneer Grill as well. Biscuits and gravy, the whole 9 yards. So, all right, we got some movement coming on the back of this speech. We got equity markets moving up higher, about 0.4% across the board, so solid move. Low volume, as you would expect, on an August Friday, because smart people are on the beach or the golf course or floating on a lake somewhere. But the action's really in the bond market here. We've got kind of a flattening of the bond yield curve. I only know that because Lisa Abramowitz taught me that years and years ago. We got the 2-year Treasury yields up almost 9 basis points, 4.32% we'll call it. And we've got the 30-year actually down 1 basis point. So if you look on the kind of the 2s, 30s, if you want to look at it, it's flattening out there. So that's the market telling us, we're feeling more confident about a rate hike in the near term, and maybe less inclined or less concerned about inflation in the longer run. That's what the bond market's telling us. I'll go with it, so we'll see what's happening. Coming up, we're going to talk about the municipal bond market. Nick Carollo, he's Bloomberg Municipal Finance Reporter. We'll talk about the latest on the muni bond market. Record issuance over the past couple of years in the municipal bond market. What's going on in 2026? I'd say if you're a New York City resident, you get a GEO paper and get a taxable equivalent of about 9.
Please go to my store, the-studio-reykjavik.com, and get the Super Strong Relief. This is a topical that you rub on an area on your body that is sore because of pulled muscle, a tension headache. You can put it on your temples or on your neck, shoulder muscles. They'll relieve the tension headache. A sprain, or even arthritis. Many people will purchase this and use it as a way to reduce the pain or eliminate the pain if they have arthritis. So please go to my store and get the Super Strong Relief. And I also have collagen. Not collagen, collagen. The collagen. And collagen will help to improve your skin, your nails, your hair, your musculature, your bone density, and help with joints. Now, you can take this with the collagen, which will help to remodel the joints. So collagen are the components that you need to help remodel your joints. And collagen helps to recruit those building blocks. Now, collagen will help also with your skin and your nails, your hair, musculature, bone density. So it's important to do some resistance exercises to help with your joint health and your bone density, but also take care of your skin. And a great way to do that is to take the collagen and take the vitamin C and magnesium supplement that I offer on my store. Drink filtered water, and what will happen is that the vitamin C and the water and the collagen will cross-link and improve the dermal layer of your skin. So you're improving the middle layer of your skin. Now, to improve the topical layer of your skin, the top layer, you can use the structural nanosilver gel. Use it as a daily topical, maybe at night. Use the collagen and the vitamin C, drink filtered water, that will help with the dermal layer. And to help with the basal layer, the bottom layer where your new skin cells are generated, take the resveratrol and the C60. And if you follow that, you're gonna really improve your skin. So please go to my store, the-studio-reykjavik.com, and get the great supplements I offer and save some money. Use discount 5, it's all caps, discount 5, and you get $5 off. If you want to save even more money, get the anti-aging boxes and longevity boxes, because they're procured in such a way, I've curated them in such a way that will help you to move on that anti-aging journey, but at a lower price point. And you can use that discount on top of it. So there are many ways to save money on my store and get healthy. And again, the premise is really simple. Government's not going to help you when you need them. And your physician, when the whole medical industry doesn't care about you. So you need to take care of yourself. You have to be self-reliant. And to be self-reliant in terms of your health, it's changing lifestyle, taking the right supplements, taking charge of your life, making sure you get your screenings that you need and catch something early. But lifestyle change is really important. Proper diet, proper exercise, drinking filtered water, staying away from processed foods, learning new things, making sure that you do resistance training more than cardiovascular training, do some stretching and balancing exercises that activate that cerebellum so you're improving your gait. And over time, you're going to notice that you're aging slower. You're getting more muscle. And when you're doing those exercises, those muscle building exercises, those resistance training exercises, make sure you do back exercises. That is an underdeveloped area of the human body. And what that will do is it's going to improve your posture, improve lymphatic flow, so your immune system will improve if you have better back posture. And you're going to be able to have better venous return flow to your heart, so your cardiovascular system will improve. And when you build more musculature in your back, you're also improving posture, you're improving the alignment of your spinal cord, and you're improving the density of the vertebrae. And over time, this is going to be very beneficial to you when you get into your geriatric years. So it's really important to pay attention to what I'm saying. Back muscles, super important. Also, leg muscles. Why? Because calves are your second heart. It's going to help pump that blood back to your heart. The venous return flow will improve with better calf muscles and improve the other leg muscles that you have. There is a correlation to longevity and muscle mass in your legs. If you don't have muscle mass in your legs, you actually are reducing the number of years of your life. I know it sounds odd, but there is a direct correlation between muscle mass in your geriatric years and the age that you expire. If you don't have enough muscle mass, you expire earlier. If you have the right muscle mass, then you live longer. And it's a very simple thing. The venous return flow is better. You're also being able to reduce the fluid that's in the interstitium. And so you're going to have better lymphatic flow, right? So these simple things can radically change your body. Instead of, you get sick and then you have to be dependent on some sort of diuretic or, metformin or some beta blocker, and it's just a downward spiral because you're dependent on pharmacopoeia. That's not the right way to go. The right way to go is to follow my lead here, and you will be a lot better off. Take control of your own life, because there's no physician out there that cares, and the government doesn't care. The answer to our healthcare crisis in the United States isn't adding more money to research. It's not adding more money to health plans. It's actually waking up and realizing most of the diseases in the United States, most of the major diseases that people have in the United States are self-induced. And most of them can be corrected. So please go to my store, the-studio-reykjavik.com. Get healthy. And by the way, pay attention to the show, you'll make some money. Because when the market does crash, you think the government's going to help you? No. The government's going to help the banks. The government's not going to help you. So wake up. Please go to my store, the-studio-reykjavik.com. Thank you for listening, and have a nice day.